A lot of people believe that when they bring a big pile of cash to the bank, the smart move is to keep it just under $10,000. It sounds cautious, it sounds responsible, and it's been passed around for years as if it were official guidance from friends, neighbors, even family members. Curious, what most people, especially retirees, don't realize is that this exact habit can create the very situation they're trying to avoid. The moment someone starts slicing a larger amount of cash into smaller deposits specifically to stay under that number, they can accidentally cross into an area federal law takes very seriously: size. And in many of the real-world cases where this becomes an issue, the people involved had no bad intentions at all. They weren't hiding money or doing anything improper with it. Maybe they sold a truck they'd owned for 15 years, accepted some help from their children, or simply moved savings from one bank to another. Completely normal events. But banks and regulators don't see the personal story behind each transaction. They see dates, amounts, and patterns. Sometimes, those patterns send a signal that leads to questions. I'm going to walk you through how this works, step by step. Once you understand the rule behind that $10,000 number, the whole topic becomes clearer and much easier to avoid problems with. A little later, I'll share the story of a retired teacher who ran into this issue while she was simply trying to organize her accounts after her husband passed away. Her experience shows how easily this can affect people who've done everything right their entire lives. Hi, I'm Artur, and I spend a lot of time studying financial rules and banking practices that frequently surprise retirees. Not because the rules are hidden, but because the way they actually operate is often very different from what people hear through word of mouth. Over the years, I've noticed that certain money rules spread quickly in retirement communities and families. One person hears something from a neighbor. That neighbor heard it from a bank employee years ago, and before long it turns into something everyone treats as fact. The so-called $10,000 deposit rule is one of the most misunderstood examples. People hear about it and then try to work around it, without realizing that the workaround is often what creates the issue. This video is for general information only and is not financial, tax, or legal advice. Always do your own research and speak with a qualified professional about your specific situation. In this episode, I'll explain what the $10,000 rule actually says, what banks are required to report, and why the report itself is usually not the problem. Then we'll look at 3 situations where retirees most often run into trouble: selling something for cash, receiving money from family, moving savings between their own accounts along the way. I'll show you the simple documentation that can protect you if questions ever come up later. Once you see what the system is really looking for, the solution is surprisingly straightforward and often the opposite of what people have been told. To understand why there's so much confusion, you first have to know what the $10,000 threshold really means. In the background, banks in the United States are required by federal law to file something called a currency transaction report whenever a customer deposits more than $10,000 in cash in a single transaction. The key word is cash, physical bills, not a check, not a wire, not an electronic transfer from another account. If more than $10,000 in paper currency goes into an account at once, the bank's system automatically creates that report. This happens quietly and routinely. The bank doesn't ask for your permission, and most customers are never told it happened. The report simply becomes one more entry in a large database that regulators use to monitor large cash movements across the financial system. Every year, millions of these reports are filed. The vast majority never lead to a phone call, an investigation, or any follow-up at all. They are records, not accusations. The rule was created decades ago to help detect serious financial crime. Things like large-scale money laundering or major illegal enterprises that depend heavily on physical cash because electronic transfers leave a clearer trail. So regulators built a system where big cash deposits are automatically documented. Here's the part most people never hear. The report itself does not mean anyone believes you did something wrong. It does not, by itself, launch an investigation. It simply notes that this amount of cash was deposited into this account on this date. Think of it more like a receipt in a very large filing system than a warning light. The real confusion starts with what people do after they hear about the rule. At some point, someone decided that if banks report anything over $10,000, the clever move must be to stay under $10,000. That idea spread quickly. You've probably heard versions of it. If you have $11,000, just put in $9,000 now and the rest next week. Split it between different accounts so nobody notices. Have your spouse deposit part of it at another branch. On the surface, that sounds like common sense problem solving. But the law specifically anticipated this behavior. When someone intentionally divides a larger cash amount into smaller deposits to avoid crossing the $10,000 reporting line, it enters a different category. That behavior has a specific name: structuring. Structuring, arranging cash transactions for the purpose of evading reporting rules, can be treated as a federal crime on its own. The irony is that many people who fall into this pattern are trying to be cautious, not deceptive. Someone spends 40 years working, saving carefully, doing everything by the book. Then they hear this well-intended advice about staying under $10,000, and the way they deposit their own money begins to look to a computer system like exactly the kind of pattern regulators are trained to watch for. The reason structuring is handled so seriously is that it was, for many years, a common method used by criminal organizations to push large amounts of cash through banks without triggering those automatic reports. Instead of depositing $50,000 in one visit, they would send people in with a series of smaller deposits, often at different branches and on different days. Regulators learned to look for those patterns, and today's monitoring software is very good at spotting them. It doesn't know whether the person making the deposits is a criminal or a retired teacher. It sees repeated cash deposits that seem designed to stay just below the reporting threshold, and it flags that pattern for review. This is where it becomes particularly frustrating for retirees. The people who get caught in these patterns often believe they were doing the responsible thing. They thought they were avoiding hassle. They thought they were staying off the radar. In reality, the steps they took to stay unnoticed can be exactly what draws attention. That's why understanding this rule matters. Not because putting a large, legitimate amount of money in the bank is unsafe. It generally isn't. But because misunderstanding the rule can lead people to make choices that create unnecessary questions later. So where does this show up in real life? For retirees, 3 situations come up again and again. The first is selling something for cash. This is extremely common. It might be a pickup you no longer need, a boat that's been sitting and used, an RV that hasn't left the driveway in years, or a classic car you've kept since your kids were small. Private buyers often want a simple cash deal with no bank financing involved. Imagine a buyer comes to your home, looks at the vehicle, agrees on a price, and hands you $11,000 in cash. You sign over the title, they take the keys, and everyone's happy. It's a straightforward, legal transaction. You then go to the bank and deposit the $11,000 in cash. Because the amount is over $10,000, the bank's system automatically files a currency transaction report. That's the end of the process in most cases. The teller might not even mention it. For them, it's routine. Later, you mention the sale to a friend over coffee, and they say, you shouldn't have put it all in at once. If you keep it under $10,000, the bank doesn't have to report it. Sometimes they mention $9,900 or $9,500 to be safe, but the theme is always the same: stay under the threshold. So the next time you receive cash, maybe from selling another item or getting a large payment, you decide to follow that advice. You deposit $8,000 now and $3,000 later. It feels cautious and organized. From the software's point of view, though, that pattern can look exactly like someone trying to avoid the reporting rule. That's when a completely clean transaction can start to look unusual, not because of the money itself, but because of the way it's being broken up. In many cases, the safer and simpler approach is the opposite of what people assume. If you legitimately receive $11,000 from selling a vehicle, you generally want to deposit the full $11,000 at once. Let the report be filed. There's nothing inherently wrong with that. What protects you is documentation. A bill of sale showing who bought the vehicle and for how much. The signed title showing the change of ownership. The bank receipt or statement showing when and how much you deposited. Those records together tell a clear story. If anyone ever asks, which is rare, you have a neat paper trail showing where the money came from. The second situation where retirees run into complications is within families. It's very common for adult children to help their parents financially. Medical bills pop up. A roof or major repair can't wait. Sometimes a child has a strong year in their career or sells a business and wants to give back. A son might say, "I'm going to give you $15,000 to help with the house." A daughter might send money to cover medical costs that insurance didn't fully pay. These are normal, legal situations. And the tax rules around gifts are often misunderstood. In many cases, the person receiving the gift does not owe income tax on it. A genuine gift is usually not treated as taxable income for the recipient. The confusion starts when everyone tries to make it easier. A child might suggest, "I'll send it in smaller amounts so the bank doesn't make a big deal about it." A spouse might say, "Let's put part in your account and part in mine so it doesn't look too large." All of those ideas come from a desire to avoid perceived hassle, but they can unintentionally create the same structuring pattern as before, a series of cash deposits clearly designed to stay under a line. A cleaner way to handle a family gift is typically to move the full amount in one clear transaction. If the gift is by check or wire transfer, the paper trail exists automatically. The bank can see where the funds came from and where they went. If the gift is in cash, depositing the entire amount at once and keeping a simple note can be enough. That note doesn't have to be fancy or notarized. Something like, "I gave to as a personal gift on." Signed. Combine that with the deposit receipt, and you have a straightforward explanation sitting in your records if questions ever arise in the future. The third situation, the one that surprises most people, is when you're simply moving your own money between your own accounts. This is where the retired teacher's story comes in. She had spent more than 40 years teaching. At 69, recently widowed, she was trying to put her financial life in order after her husband passed away. Like many long-married couples, they had accumulated accounts at different banks over time. An old checking account from when they bought their first home, another account opened later for convenience, a certificate of deposit that had been renewed several times. Financially, nothing was particularly complex. Emotionally, it was draining. When you've lost a spouse, even ordinary paperwork can feel overwhelming. Her goal was sensible: bring everything into one bank so it would be easier to manage. That kind of consolidation is something many advisors recommend. Fewer accounts means fewer statements and less confusion. But the way she moved the money caused an issue. Instead of transferring the full balances in a single step, she made several smaller moves over a few weeks. $9,000 one week, $8,000 another, then another transfer just under $10,000 shortly after. She wasn't thinking about the reporting rule at all. She just assumed smaller transfers would be easier while she was already dealing with funeral arrangements, estate work, and other paperwork. About 6 weeks later, she received a letter asking her to explain the pattern. She hadn't done anything wrong. These were her own savings. But to the monitoring software, all it could see was a series of deposits repeatedly landing just below the $10,000 line within a short period. That behavior is one of the patterns the algorithm is designed to notice. Most of the time, once a clear explanation and supporting documents are provided, the matter goes no further. But the stress of receiving that letter, especially when you're grieving, can still be significant. This highlights a key reality about modern banking oversight. Much of it is pattern-based and automated. Software looks for behaviors that historically matched financial crime. Repeated cash-like deposits that appear designed to avoid reporting are one of those behaviors. Moving your own money between your own accounts, even in large amounts, is legal and common. People do it when changing banks, consolidating, or rolling over maturing CDs. The transfers themselves are not the issue. It's the repeated pattern of staying just below $10,000 that can be misread. So when you need to move a larger sum between institutions, it's often simpler and clearer to do it in one transaction if you can. A wire transfer or cashier's check accomplishes this and creates a record showing exactly where the money started and where it ended up. If a bank employee asks, "What's the source of these funds?" that's normal. They're doing their job. A short answer like, "These are my personal savings being transferred from another account I own," is usually all that's needed. The documents you keep in cases like this are straightforward. A statement from the original account, showing the balance before the transfer, the wire transfer confirmation or cashier's check receipt. If it came from a maturing CD, the notice of maturity and payout together. Those records form a clear timeline of what happened. This brings us to the part many people overlook. What really protects you is not trying to avoid reports or thresholds. It's having a clear paper trail that explains your transactions. Once you understand that, your focus shifts from, will this trigger a report, to can I explain this easily if someone asks? That's a much more practical way to think about it. In most situations, 5 simple types of documents can make that explanation very easy. Something that shows why the money exists. For a sale, a bill of sale. For a family gift, a brief gift letter with the amount and date. For moving your own funds, a note or record explaining the transfer source's statement from the account the money came from. This answers the question, where was the money before it arrived here? Proof of the transaction itself. A wire confirmation, cashier's check stub, or deposit slip showing the date and amount. Consistency with your tax records, when applicable. For example, if you sold property or equipment, having that reflected correctly on your tax return helps your bank and tax records tell the same story. A clear, concise explanation if someone asks. Often, a short, direct answer supported by those documents resolves things quickly. If a situation ever seems more complex, that's when it can make sense to pause and talk with a CPA, tax professional, or attorney before responding further. Viewed together, none of this is complicated. It doesn't require legal training. It's simply about keeping records that connect financial movements to real-life events. Before we finish, let's address a few common myths about the $10,000 rule that cause a lot of unnecessary worry. Myth 1. If I always deposit $9,900, I'm safe. In reality, $9,900 is one of the most commonly watched deposit amounts because so many people believe this myth. Banks don't just look at deposits above $10,000. They also look for repeated deposits just below that line. A pattern of consistently landing at $9,900 can be more noticeable than a single, honest deposit above $10,000. Myth 2. Only people doing something illegal ever get questions. That sounds reassuring, but it's not accurate. The monitoring systems are algorithm-driven. They flag activity based on patterns, not on someone's reputation or intentions. That means completely honest people can receive routine requests for clarification. Once they provide a reasonable explanation in documents, the matter often ends there. Myth 3. Once I'm retired and on a fixed income, this doesn't really apply to me. The reporting rules don't include an age or retirement exception. A cash deposit by a 75-year-old retiree is processed under the same rules as a deposit by a 35-year-old business owner. The system records the transaction the same way. Understanding that is actually helpful because once you know the rules are neutral, you can plan accordingly and avoid accidental mistakes. When you strip away the rumors and half-truths, the core reality is simple. The system was built to monitor large movements of physical cash to help detect serious crime. It wasn't created to target retirees who sell a vehicle, accept help from their children, or reorganize long-held savings. The report itself is usually not the issue. If you deposit more than $10,000 in cash, the bank files the report, and for most people, that's the end of it. The real problems tend to arise when people try to work around the rule by breaking a legitimate amount into smaller deposits just to avoid being reported. If there's one key idea to remember, it's this. Avoid splitting up a cash deposit or transfer solely to stay under the $10,000 line. Instead, handle legitimate transactions openly and keep a few simple records that explain what happened. In practical terms, that often means 3 habits. Deposit or transfer the full legitimate amount instead of slicing it up to dodge the threshold. Save basic documentation, bills of sale, gift letters, statements, and receipts as a short written history of your transactions. When moving your own savings between accounts, try to use one clean transfer where possible and keep the confirmation from the bank. When people run into trouble around this rule, it's rarely because they meant to do something dishonest. It's usually because they followed advice that sounded wise but was backwards, like always stay under $10,000 or break it up so nobody notices. Transparency and documentation are what keep things simple. Now that you know how this rule actually works, you're already ahead of most people. You don't have to rely purely on secondhand tips. You understand what the system looks for and how normal, honest transactions fit into that framework. If you're comfortable sharing, I'd be interested to hear about your experience. Let me know in the comments which state you're in and what kind of situation you deal with most often: selling property, receiving family gifts, or moving savings between accounts. Everyone's circumstances are a little different, and your comments help show which topics are causing the most questions. Thanks for spending this time with me, and I'll see you in the next video.